The biggest mistake investors make is asking what to buy instead of understanding when to buy it. Look at the chart for a moment. What would you choose today? Stocks? Gold? Commodities? Now ask yourself something more uncomfortable. Is your money actually growing or quietly losing value every day? Because the reality is simple. Inflation is elevated, real interest rates are low, and purchasing power is being eroded continuously. Yet many investors are still positioned as if nothing has changed. So the real question is not what to invest in, but are you positioned for the world we live in today? Most people follow headlines, but markets don't move because of news. They move because of one underlying force: inflation, and how central banks respond to it. Once you understand that, market behavior stops feeling random and starts feeling logical. There is a pattern most investors overlook. When inflation falls, stocks tend to rise, often strongly. This happens because falling inflation usually leads to lower interest rates. Money becomes cheaper, borrowing increases, spending improves, and businesses grow faster. At the same time, future earnings become more valuable. Investors are willing to pay more for growth, and liquidity flows into markets. That combination creates the kind of rallies that feel sudden but are actually predictable. Now consider a different environment. What happens when inflation stabilizes? Interest rates stop moving aggressively. Businesses can plan. Costs become predictable. Uncertainty fades. Markets don't surge in this phase. They move steadily, gradually building value over time. It's not exciting, but it's stable. Now flip the situation. What happens when inflation starts rising again? Central banks step in and raise interest rates. Borrowing becomes more expensive. Spending slows. Margins tighten. Growth weakens. At the same time, higher rates reduce stock valuations. This is where many investors get caught off guard. Stocks don't just slow down, they often decline. And the key shift begins. Money starts moving elsewhere. If money leaves stocks, it has to go somewhere. And history shows a clear pattern. It moves into commodities, precious metals, and mining stocks. But each of these behaves slightly differently. Want to go deeper into your investment strategy? Visit www.vestinvesting.com. Find the full article linked in the video description.